All right, well, thank you for tuning in. Today, we're going to be talking about how the Rockefellers, the Carnegies, the Murdochs, Disney, and all these people built wealth. And it's a way that you can too, from any investor, from a beginner to a very sophisticated person. And for that, I've got Daniel Reitz in today. I've got Alyson Whelan. Guys, thank you for coming and walking us through this.
You're more than welcome. Happy to be
Thanks for
here.
having us.
You bet. I think it's something that's a little overlooked out there. And because I've been talking to some of our newer agents, and they just think, oh, we can't do that right now. So can you kind of walk us through how these people really built their wealth and how we too can capitalize on it and go down that same path? Maybe not at that level, but we can get a good start anyway.
Well, the interesting thing about it is most of the families that you mentioned,
Yeah.
along with a whole host of other businesses, have been started with the proceeds that are borrowed against cash value life insurance.
Yeah.
And
hmm
the idea there is you have a tax advantaged way to create wealth that is a completely different asset class. It's not stocks and bonds. It doesn't fluctuate that way. It's
Right.
based on a completely different profile of how insurance companies make money. And it's been a primary savings and investment vehicle for banking and corporate America for hundreds of years.
Yeah.
And with the advent of the internet and public information and people getting more aware of it and kind of thinking back that, oh yeah, I remember my grandfather borrowed against his policy to pay for my parents' wedding.
Yeah.
Uh, it gets overlooked. It's not sexy. It's not like Bitcoin. It's not like high flying stocks. It's very fundamental investment
Stable.
101.
Yeah. Well,
Yes.
it's stable. And the thing that when I talk to some of our real estate agents here, guys, is I guess they're intimidated by it, or they think that they're just too young to get into it. And we know that's the case. But Allison, I know you have children. Do you have
I
a
do.
program set up for them already?
I do. I have four kids, ages 13, 11, 9, and 6, and they all already have whole life insurance policies. And I'll continue adding to those policies. And then when they hit a certain criteria that I've set for them, then they'll take ownership of those policies as well.
Yeah. Yeah. So I mean, that really gives them a leg up in the future. And I just
It
think,
does, and it can help with college costs, and it can help with all sorts of things if they want to start a business, et cetera, et cetera. They're already going to have a set amount of cash accumulated,
sure. Now
which is
let's
awesome.
let's let's kind of break it down. Let's start with the novice investors, how they can start, and then sophisticated investors. So if I'm a novice investor, so I need to get my insurance in place.
hmm
Well, obviously, I make my payments. How long until I can start pulling against it or withdrawing against
Depends on how it's written.
It's a design issue.
it? Okay.
Go
It
ahead,
depends
Alex.
on
I'm
how
sorry.
it's written. Yeah, it's okay. It depends on how it's written. There are certain ways that we can develop and write the policies so that way you're able to utilize the cash value sooner. And there are others that you're going to have to just hang in for about a year or so before you have access to the liquidity.
That's soon.
hmm
I thought
Yeah,
you were
there are certain techniques that you can use in terms of policy design for the early on investor. Certainly, assets available for investment are an issue, can be a budget issue. So
Yep.
the perfect plan would be immediate coverage at very low cost, and then everything else just goes into building the cash.
right.
And that's literally what happens because the younger you start, the better it works. The numbers when you start your kids' policies in their infancy is staggering. There's a very old rule of thumb. It was called $1 Million Baby, and it holds as true today as it did back in the 50s when the companies like Gerber Life and a lot of
Yep.
other infancy life, they literally marketed the insurance through baby products
Yep.
back in
I
the 50s.
remember that.
And now
Yep.
there's a level of sophistication associated with it where I think the intimidation factor isn't so much that it's not understandable. It's that it doesn't work like everything else.
Right.
It's
Correct.
different and
It's
therefore
different, so it's a little
unfamiliar.
scary. Yeah.
They're just scary. Sure,
Yeah.
people, they just
Correct.
don't approach it the same way.
Right. Costs. Let's talk about costs. Is it expensive to set this stuff up, or cheap?
That's a matter of perspective, honestly. I like to think of it as a contribution because you're essentially paying yourself is what you're
Right.
doing, and then getting interest and dividends on top of that. And there's lots of ways of making sure that it's within a client's particular budget.
Now, if you're buying real estate, you can do any asset class, right? There's no restrictions on this.
Correct.
Okay.
Yep.
All right. How about interest rates? I'm trying to think of what every new investor's thinking. Oh, Joe, I wish you would have asked. So if you guys come up with something, please let me know. But
Yeah, the interest rate structure is pretty straightforward. Most mutual life companies have dividend histories in excess of 150 years. To borrow against those policies, you're talking about a third of what credit card rates usually run, or maybe even a little less.
Mhm.
It can be somewhat variable, but it is very consistent and trackable. And in cases of the largest of the mutual life insurance companies that are owned by the policyholders, it's kind of wild. If you want to go out and buy stock in The Guardian, or you want to go out and buy stock in New York Life, you can't. The owners are the policyholders. So any funds that are produced by them as a business go back to the owners. It's kind of like when you think about a commercial bank versus a credit union. A commercial bank makes a profit and the owners of the bank make money.
right.
In a credit union, the credit union turns a profit and it comes through in the form of lower interest rates on loans and higher interest rates on savings. Same idea, except with life insurance and a mutual company, you've got the added benefit of tax exempt status for those dividends, which
Yep.
Okay.
is very powerful in today's economy where people think taxes are high now, but historically we're at kind of low tax rates,
Yep.
considering
Yeah.
what it was in the 50s and 60s, approaching the 70% range for some
No,
income
and
earners.
it's your money. That's the thing is what people have to
It's
remember.
your money.
Your money.
It's your money. Absolutely.
Now,
It's important what you make, but it's more important what you keep. Outcomes at the end of the day are the only thing that counts.
right,
Absolutely.
exactly. Is there any repayment penalties if you decide to pay everything back right away, or
No.
probably
No.
not? Right, just
Nope.
put it back in.
Just
Okay.
stick it back in and recycle, reuse.
Right.
What's
redeposit,
really
revolving
interesting
door.
What's really interesting is if you borrow against that cash value continues to receive the dividend,
Yep.
depending on how you structure the loan and how that loan's recognized by the insurance company. And we always try and structure these things so that your cash value is making its dividend. You borrow against it, it still gets the dividend, and you're paying interest on that loan. And in a lot of cases right now, there's a spread where you actually make a little more than what you pay.
Right.
And that gap and what you make is tax exempt, and what you're paying, if you use it for a business purpose, like an entrepreneur, it may be tax deductible. So that spread's even wider. And
Yep.
so that's where, and when you see the difference between the novice investor and this more sophisticated investor,
That's
if
where the
you're borrowing for
sophistication
business
comes
purpose,
in.
that gap, that's essential in banks do it all the time. Corporate America does it for cash management. That's how the big get bigger.
Yeah.
You know, they say it takes money to make money.
Yeah,
That's a
it's really
fundamental
good.
truth.
I'm not hearing any downsides. Are there any? What do we got
If
for a
You,
downside?
you
are
just
not
have to
healthy-
qualify. If you're not healthy or you have some type of bizarre illness or something like that, this is not going to fit for you. So there are some qualifiers that need to
Okay.
happen.
And I'm going to tell you right now, and this is a public service announcement, don't smoke. Smoker rates,
Are so much higher.
yeah, because it's statistically attributable to early death.
Yep.
Regardless of tradition, taxation, whatever. The reality of it is when you study the causes of death, the insurance companies have been doing it for close to 400 years now. They started in a church, they ended up as a big business. They study how many people die from what. And
Right.
the contributing factor that it's the second item on the application.
Yeah.
Do you smoke?
Yeah.
Don't do it.
Yeah, I don't understand it anymore. It's just kind of
It's gross.
you get in an elevator with somebody.
Yep.
Yeah, so I guess we touched on sophisticated investors already, but it's something that I think people should really be taking a look at. This I think
Absolutely.
can create a lot of opportunities for somebody new or newer investor or a sophisticated investor.
Absolutely.
I
Oh,
just
yeah.
think it'd be a great way to do about. So now, how do we get hold of you guys?
Um,
That was the toughest question yet. It took you both
That
a while to
is.
answer.
no, I don't know how kosher it is, but if you want my cell number, you can have it. Call me.
Yeah, let's have it.
Yeah, absolutely. You can have
It's
mine as well.
610-217-1655.
Okay.
If you're interested in learning more, call me or Alyson.
My
Okay.
number is 862-432-1700. I'm also on LinkedIn, so that's another easy way to connect with me too.
Okay.
I'm on LinkedIn and Facebook and all that stuff, but
Me as
Find
well.
it everywhere.
Allison is very tech savvy.
Yeah.
Dan is an old guy. I like to talk on my phone. I don't type on my phone.
You
Call
can
me.
text me anytime. It's all good.
Yes, sir.
Oh, yeah, you'll get all the calls. Dan, you're shit out of luck, buddy.
Exactly. Just
Story of my life.
It'll be
Yeah,
fun.
well, you guys, thank you very much. This has been a lot of great information. When you reached out, I thought, man, this is something that I just think a lot of the younger generation probably doesn't really think about. And I mean, I know I've talked to our agents here, and they just think that they were too young. And so I think I'm excited to show them this video, and hopefully they'll reach out to you guys.
That'd be great.
Thank you for taking the time today.
And
Absolutely.
when people are considering a first home purchase,
Yeah.
for the average person, it's the largest investment they'll ever make.
Sure.
And if something should happen to the breadwinner or breadwinners,
Yeah.
and there are children involved, or the home isn't readily liquid, there's nothing going to make you sleep better at night than knowing the people you care about can carry on in your absence if the unthinkable happens.
Right.
And that's really the bottom line. It really is a service business, because not only are we providing benefits that we've talked about while you're alive, but we also carry on that legacy. And if we do it right, your kids will sing your name around the campfire long after you're gone. It's the closest thing to immortality that I've found available commercially.
Sure.
Correct.
All right. Well, guys, thank you very much. I will put your contact information down below. I appreciate all the information. Now, if you're watching this show today, make sure you give us a like. And if you haven't done so, make sure you subscribe. Thank you, guys.
Thank you.